All right, quick promise up front. By the end of this, you'll know what a holding company actually is in Canada, when it makes sense to use one, when it does not, and how it fits into real life for business owners. I'll keep it in plain, simple words and use a very simple story so it gets right into you. So, what's a holding company? Think of it as a bucket company that holds stuff. And stuff could be cash, investments, real estates, or shares of your operating company. It does not sell muffins or fix roofs. It is just owning things in it. Your operating company does the work, sends the profits up to the holding company, and holding company holds it. So, why would anybody bother? Why would anybody even think about it? There are 5 big reasons. Number 1, asset protection. Number 2, helping you qualify for lifetime capital gains exemption. Number 3, tax savings in certain cases. Number 4, tax deferral and timing. And number 5, estate planning, succession planning. So let's walk through each one of them in details in very simple language. So I said the first one was asset protection. If your operating company is where the risk lives, like your contracts are there, your staff, trucks on the road, you generally don't want a big pile of investment sitting inside that same entity. The idea is earn profits in your operating company, which I'm going to refer as OpCo, move excess cash up to the holdco by the intercompany dividend, and keep the nest egg out of the line of fire. Picture a contractor who's been profitable for years. If something goes sideways on a job and there's a lawsuit, you want as little as possible sitting in that operating company. Shifting retained profits to a holdco builds a wall. It's not magic. Creditors can still challenge sham moves, but if it's done properly, it's a real layer of protection called character proofing. Now, second, as I mentioned, the Lifetime Capital Gains Exemption, also called LCGE. In very broad strokes, if you sell shares of a qualifying Canadian-controlled private corporation, you can shelter roughly around $1.25 million of capital gains from tax. It's huge, but there are tests. A big one is the asset test at the time of the sale. And substantially all, think 90% of the company's assets must be used in the active business. If your OpCo is stuffed with passive investments, you can fail that test. So what is the fix? The fix is purification. Clean the OpCo. Push non-business assets, cash, piles, marketable securities up to the holdco well before a sale. That way, when a buyer shows up, your operating company looks like a business, not an investment portfolio, and you are far more likely to qualify for the lifetime capital gains exemptions. That takes me to number 3, the third, which is tax savings. Sometimes. This one depends on your province, your personal income, and the type of investment income. In certain situations, earning investment income inside a corporation and then paying it out later can shave some tax compared to holding everything personally at the top bracket. It's not automatic, and the rules around passive income in corporations have tightened over the years. So you absolutely want an accountant modeling this for you. But in the right fact pattern, a holdco can keep more after-tax dollars compounding. That takes me to number 4, which is tax deferral and timing. This is about control. Maybe your operating company had a great year and wants to pay a shareholder dividend, but you personally are already in a high bracket this year. If your shares are owned by a holdco, the OpCo can pay a tax-free intercompany dividend to the holdco now, and you can pay yourself from the holdco next year when your personal income is lower. Same money, but better timing. That sort of flexibility is incredibly helpful when there are multiple shareholders with different needs or when your personal income bounces around. So that takes me to number 5, which is estate and succession planning. If you're grooming a successor, a daughter stepping into the business, and son joining the shop, or you can use a holdco as a part of the estate fees. In simple words, You freeze your value today and let all the future growth accrue to the next generation through new common shares while you keep control and clarity around tax at death. It makes hands-off smoother, keeps CRA surprises to a minimum, and gives everyone a clear path ahead. All right, let's ground this with a couple of quick stories. Imagine a small electrical company that did solid work for a decade. The owner left profits in the opco because, hey, it was easy. After a few good years, there's a $500,000 sitting in the account, invested in simple ETFs, then a defect claim lands. Without a holdco, all that retained cash is sitting right where the liability is. Now, replay it with a holdco. Each year, the owner swept excess cash up to the holdco. Same profits, but now the operating company stays lean and the long-term savings are out of its harm way. They are sitting in the holdco now. Another one. Let's discuss another example. A software founder gets an offer to buy his company. He's thrilled until the accountant says, you've got too much investments cash inside the opco. You might fail the Lifetime Capital Gains Exemption's active asset test. Because he had been moving cash to a holdco for years, he is fine. He sells shares, qualifies for the exemption, and shields a big chunk of the gain. That's the difference between reactive and proactive. Now, I want to be fair. Holding companies are not free money. There are real downsides. There's a setup cost. You'll pay to the accountant for incorporating it. Ideally, you do it through a lawyer. There are cheaper online options available, but get proper advice around proper share structure. There's ongoing costs, annual corporate filings, minute books, tax returns. One more entity means one more set of books you have to handle, manage, and pay. There's admin and complexity, more accounts, more intercompany transactions, more places to make a paperwork mistake. You definitely want a professional keeping you between the lines so that everything is aligned. And yes, if you set it up wrong, you can absolutely pay more tax, not less. A classic example is holding the wrong type of investment in the wrong entity or pushing so much passive income into your structure that you grind down your small business deduction in the opco. This is why you bring your accountant, you bring your lawyer, and a planner on the same table. A couple of quick practical tips if you are considering a holdco. Move excess cash regularly. Don't wait until a lawsuit or a sale is on the horizon. Keep a clean trail on intercompany dividends. If you're even vaguely thinking about selling in the next few years, start purifying your operating company now. Get non-business assets out so the active asset tax won't be an issue later on. If you're planning an asset freeze, make sure your family understands the why, the timeline, and who controls what. Clarity solves problem before they even start. And finally, the question I get all the time, do I need a holdco? If your business is growing, you're building retained earnings, you care about asset protection, and you want flexibility on tax timing or succession, it's worth exploring. If your company is still early, cash is tight, and there are not meaningful investments piling up yet, you can probably keep it simple for now and revisit when the numbers justify the extra cost and complexity. If this got your wheels turning and you want to sketch out a structure that fits your situation, you want to know what to hold, where, how to keep the lifetime capital gains exemption in play, and how to prepare for succession, I'm very happy to walk through it with you. The right setup, done once and maintained well, can save a lot of tax and a lot of stress over the next 10 to 20 years. Thank you so much for watching it till the end. Stay tuned for my next video where I'm going to come up with another good topic. Till then, take care. Thank you.